What if I told you the Federal Reserve might be just days away from ending one of the biggest monetary tightening cycles in history? We are talking about quantitative tightening, or QT, the process that's quietly drained more than $2 trillion of liquidity from the US financial system since 2022. Now, JP Morgan and several major banks say this process could stop as early as next week at the upcoming FOMC meeting on October 28th and 29th. If they're right, this could mark a major turning point for markets, interest rates, and even crypto. Let's break it down: what quantitative tightening really is, why it might be ending, and what happens next. First, let's start with the basics. Quantitative tightening is the opposite of quantitative easing. During quantitative easing, the Fed buys assets like treasury bonds and mortgage-backed securities to pump liquidity into the system. Quantitative tightening does the reverse. It lets those assets mature without reinvesting the proceeds, effectively shrinking the Fed's balance sheet and draining cash from the banking system. The idea is to normalize monetary policy after periods of aggressive stimulus like the pandemic, when the Fed's balance sheet ballooned from about $4.3 trillion in 2019 to nearly $9 trillion by April 2022. When inflation spiked to 9.1% in mid-2022, the Fed launched quantitative tightening to help cool the economy. They started allowing up to $95 billion per month in securities to roll off, $60 billion in treasuries, and $35 billion in mortgage-backed securities. Fast forward to today, October 2025, and the Fed's balance sheet is down to around $6.6 trillion. That's more than $2.2 trillion drained from a system, roughly a 25% reduction from its peak. But now, there are growing signs that quantitative tightening has gone as far as it can go without breaking something. According to JP Morgan strategists, the Fed could announce the end of quantitative tightening next week at the October FOMC meeting. In a research note published on October 22nd, they said the Fed may need to halt balance sheet runoff immediately and even inject temporary liquidity through short-term operations to stabilize money markets. Here's what's happening: short-term borrowing rates have been creeping higher. Banks and funds are tapping the Fed's standing repo facility, borrowing billions in overnight funding, which almost never happens unless liquidity is tight. And the reverse repo facility, which once held $2.5 trillion during peak quantitative easing, has now drained close to zero. In simple terms, the system's liquidity cushion is gone. Add in year-end funding pressures, corporate tax payments, and treasury auctions, and the Fed could be staring down a mini liquidity crunch unless it steps in soon. It's not just the bank saying it. The Fed itself has been hinting that quantitative tightening is nearly over. On October 14th, Chair Jerome Powell said, "The end of the balance sheet drawdown process may be nearing and could occur in coming months." When central bankers start using language like that, it usually means they're preparing the markets for a pivot. And they might pair it with something else: a 25 basis point rate cut. That would be the second rate cut since inflation started cooling off, and it could mark a shift toward more accommodative policy heading into 2026. Other institutions are on board too. Bank of America and Evercore ISI both expect an announcement in October. Jefferies thinks the Fed could fully stop quantitative tightening right away. Goldman Sachs is more conservative, predicting a January or February end. But overall, the consensus is forming quantitative tightening is reaching its limit. So, has it done its job? Actually, yes. Inflation is down to around 2.4% as of September 2025, basically back to the Fed's target. Bank reserves have normalized to about 10 to 12% of GDP, down from 20% during the stimulus years. And so far, the system stayed stable, no major meltdowns like the UK's 2022 bond crisis. But with liquidity tightening and the economy slowing, the Fed knows pushing further could create new risks, especially for employment and credit markets. Unemployment is already at 4.3%, and tightening too far could send that higher. If the Fed halts quantitative tightening, it doesn't mean we are back to full-blown quantitative easing, at least not yet. It simply means the balance sheet stops shrinking. That alone would add passive liquidity back into markets and signal that the tightening phase is over. It could ease funding pressures, lower treasury yields, and support risk assets like equities and crypto. Critics worry this could hurt the Fed's credibility if inflation bounces back, but Powell appears ready to take that risk in favor of stability. Markets have already priced in an 85% chance of a rate cut next week, so expectations are high. Markets are already reacting. Despite some volatility around trade headlines, US stocks hit new all-time highs this week, signaling investor optimism that the Fed's tightening cycle is finally ending. Treasury yields, meanwhile, fell 5 to 10 basis points across the curve, reflecting growing bets on easier policy ahead. In crypto, Bitcoin is holding firm above 110,000 at the time of making this video, with analysts eyeing a breakout toward $120,000 if the Fed confirms an October pivot. If JP Morgan's right, ending quantitative tightening could spark a liquidity thaw heading into 2026. Not a new quantitative easing, but what some call an unwind of the unwind. And that could fuel the next big move in both traditional and digital assets. So, here's the big picture after 3 years of tightening. Inflation is under control, but liquidity is getting tight. The Fed now faces a choice: risk another funding crunch or call it mission accomplished. We'll find out soon enough. The October 28th FOMC meeting could define the next phase of global markets. If you found this breakdown helpful, don't forget to like, subscribe, and follow for more in-depth coverage of the Federal Reserve, markets, and macro trends. Thanks for watching. See you in the next one.